Today we're going to do a demo of how to run a non-producing property economic model on Drillnomics. I'll go ahead and log into the app, and I'm going to add a new project. We'll call this project non-producing demo. Go ahead and save. Drillnomics will create the project, and over here you'll see the project pop up highlighted. On the Overview tab, we're going to make sure non-producing property model is selected. Now we're going to go to Production Analysis, where we're going to select files. I've already downloaded this DRI file from Drilling Info and saved it to my desktop. You could also download an IHS Production 98 file, an IHS Production for Power Tools file, or use the standard Drillnomics Excel file to upload wells. I'll go ahead and open this file, and Drillnomics will automatically normalize the data and pull out all of the well information in that file. As you can see, we've uploaded 12 wells. Information for all of them is listed here. If for whatever reason I did not want to include one of these wells, I could unselect it here, and the data will be removed from all the tables below. I am going to use this well though. So we'll go ahead and reselect it and go down here to build our curves. As you can see, Drillnomics automatically calculates your initial rate based on the data for all wells. It can calculate your initial rate based on first month or peak month production. Typically, we use peak month production when we're building our type curves. In this case, the default type curve that Drillnomics produces looks fairly close to the actual production model. The only thing I'm going to do is flatten out the curve a little bit, so make the B factor slightly less and recalculate. I'll go ahead and do that and take a look at the long-term trend. This tool over here enables you to use whatever scale you'd like for the chart. I think this looks pretty good. We'll move to the gas. As you can see, the default curve here is far too low, so we're going to go ahead and flatten out the curve substantially and reduce the decline rate substantially. I'm also going to reduce the terminal decline rate since it looks like this is a very flat production stream. We're probably going to go to 6.5. Calculate. As you can see, we're still very, very low. So here we're going to go 0.6 on the B factor. And we're going to go with a decline rate of 45. Getting closer, probably just a little bit low, so we'll go to a decline rate of 42. That looks pretty good. Again, we'll expand. And as you can see, overall, this looks pretty good. We might try to move our B factor a little bit higher at this point, which you can see flattens out the curve here, and we may go with a little bit higher terminal decline rate. I think that curve looks pretty good. Once you're satisfied with your curves, you'll move to the Financial Analysis tab. First thing on Financial Analysis is to enter your NGL yields and gas shrink factors if you have wet gas. If you don't know them, you can just leave it as 0. But for this particular area, I know that you get about 0.1 barrels per MCF of gas of NGLs, and that your shrinkage factor is about 20%. Since I'm accounting for shrink, I'm going to leave my million BTUs per MCF factor as 1. However, if you did not know what your yields were, you could leave your NGL yield and gas shrinkage factors blank and put in your million BTU for MCF ratio to enable you to get a higher MMBTU content for your gas. Now we have a 3-stream production chart, which shows you all the production for that well in both oil, gas, and NGLs. Next we'll move to net revenue. This particular example is 100% working interest lease with an 80% net revenue interest. We'll go ahead and update for 80% net revenue, and we'll get our net 3-stream production. Next, we'll move down here to pricing. You have the option to input your own strip pricing for the first 5 years or use flat prices. I like to use flat, so I'll go $50 for oil, $2.75 for gas, and $25 for NGLs. In this area, the oil differential being the difference in price for what we get at our wellhead versus what the market price is $7. Our gas differential is about 50 cents. We don't have an NGL differential in this particular area. We're going to say that the prices for all 3 production streams will increase by 2% per year. We'll go ahead and update that and get our full pricing chart. As you can see, we have every year's pricing listed in this chart. You can also, in all of these tables, expand your years to show monthly data so you can double check that everything is correct. Drillnomics automatically takes your net production and multiplies it by your pricing to give you your production revenue. Next, we'll move to the net cash flow. As we said, this is 100% working interest lease. In this particular area, we're going to say that we have $10 per barrel produced of lease operating expense, and that we have other lease operating expense of $10,000 per month, and that $10,000 will go down by about 2% per year. In this area, it costs $6 million to drill a well, so your initial capex is about $6 million. And at the end of the well's life, you have an abandonment cost of $100,000. In this area, our ad valorem and severance taxes combined are about 7.5%. We'll go ahead and update, and we'll now get our net cash flow chart. As you can see, month 1 has a heavily negative cash flow, which is based on the fact that you had to spend so much money to drill the well. But after that, the cash flows are positive. If you go down in the chart, you'll see that at year 52, the well zeroes out its production. This is because your operating expense exceeds your revenues. Next, we can go down to get the present worth profile of our well. As you can see, the PV0, which is the total undiscounted cash flows of our wells, is $4,353,182. This means that overall, that would be your cash gain, completely undiscounted. The PV8 is $312,000, and the PV10 is negative. As such, you would infer that the rate of return of this project is somewhere between 8 and 10%. Next, we'll take that single type well cash flow model and go to a build out. In this particular area, you will drill about 4 wells in each section lease. As such, we're going to go ahead and model those 4 wells getting drilled over time. So we'll select a manual build out and we'll go ahead and add a new well. This first well, we're going to suspect is going to be drilled in January of 2016. It will have 100% working interest and 80% net revenue interest, just like our type well. Calculate. Next, we'll add a second well. We'll say this well would be drilled back to back with the first well, so drilled in February of 2016. Again, same interest. Then we'll add a third well. We're going to guess that this well won't be drilled until January of 2017, and that the working interest and net revenue interest of this well will be half what the first well is because this lease will be pooled with another lease in this hypothetical situation. As such, you'd have a 50% working interest and 40% NRI. We'll calculate that. We'll add the final well, well 4. We'll say that well 4 will be drilled back to back with the third well, so in February of 2017, and it will once again have 100% working interest and 80% NRI because it will be fully on the lease in question. We'll calculate that, and now we have all 4 cash flows of each well modeled. We have the PV tables for each well here, and what you can see is that it's giving you the present value for each of these projects. We're going to go ahead and select a PV8 value for each of these projects. And down here, you can see that the well, all 4 wells, are being modeled. You can see that it models our initial CapEx and then our revenues. And that Drillnomics will automatically show you all 4 wells revenues over time, just like it shows you all 4 wells expenses. Based on our PV8 values we selected above, you can see that the total net present value production is just shy of $1 million. PV8s or PV4s or PV20s will be at your discretion, and you'll be able to determine the value based on your own parameters. Now that we're complete, we'll go to the report generator. The report generator pulls up a nice example of everything we've just done. You can then download a PDF. The PDF will generate, and you'll be able to take that to your engineers or to your management, or use it yourself to look at everything you just did. Everything you just did should give you a good valuation of the property in question. As you can see, we have a nice report, a professional report that you can use to finish your evaluation of this property and hopefully make an offer that's more educated than it should have been. Thank you very much, and look forward to more examples.